Business credit is about to change forever. Most business owners are still using outdated tactics from years ago, but things have changed when it comes to business funding and how to obtain it, and nobody's talking about it. I've helped hundreds of entrepreneurs secure funding and build close relationships with bankers, and now I'm seeing firsthand how lenders are quietly switching the way that they evaluate businesses for funding. Yes, the game has changed, but the good news is if you know how to play it the right way, you can still obtain the credit needed to grow your business and change your life. So in this video, I'm gonna break down the new criteria lenders are using to evaluate your business, how to stay in position to get maximum funding, and new opportunities that'll give you access to more business credit than ever. To start, I'm going to explain one shift lenders are making that's killing your business credit approval odds. Previously, having an LLC and decent credit was almost a guarantee to get approved for funding. I remember applying for my Chase Business Unlimited card. I didn't have a prior relationship or any other accounts with Chase, just a new business and a credit score in the 700s. When I applied, I was approved for $25,000 in minutes. Shout out to Chase. But skip to today, business owners with an even higher credit score are applying for the same card and either getting denied or receiving much lower limits. The days of easy approvals are over, and this is mainly because credit default rates have increased dramatically over the last few years. Banks have been taking major L's lending to business owners who aren't paying their debts. Now they're being a lot more cautious with who and how much business credit they're handing out. Lenders aren't just looking at your credit score anymore. Now they're doing deeper behavior analysis to evaluate your business's bank account history, using more advanced risk modeling, and even utilizing AI to determine your credit worthiness. Cash flow and history are becoming increasingly more important. This means that even with a good credit score, if your business has inconsistent revenue patterns or you're carrying high balances on your other business cards, your application could be flagged and denied. But what does this mean for you? Well, let me show you what you need to still get approved for business credit. This new era of lending focuses much less on scores and more on your business banking behavior. And if you want the best chance at high limit approvals, follow what I call the banking behavior checklist. Number 1 is a steady deposit frequency. Lenders don't want to see a large single deposit into an account. This indicates a stale account with not much activity. Instead, your goal should be multiple deposits per month, even if they're in smaller amounts. This shows consistent cash flow for your business. If lenders review your bank statements, aim for 5 or more deposits per month. Number 2, avoid negative balances and non-sufficient fund alerts. Overdrafting or getting non-sufficient fund alerts or NSFs on your business account can be a death sentence for approvals. Having 0 negative days in your account shows your business is healthy. When you overdraw your account or bounce payments, it's a red flag for lenders that suggest you aren't managing cash well. Avoid these scenarios and lenders will have fewer concerns, thus giving your business better chances to secure the bag. Number 3, maintain healthy average balances. Having deposits in your account does nothing if the money is being depleted as soon as you get it. Lenders want to see that you're keeping a decent amount of money in the account throughout the month. Your daily balance goal should be at least 10% of your monthly deposits. For example, if you're receiving $20,000 in monthly deposits, you need to maintain at least $2,000 average balance. This shows lenders you're actually retaining a portion of your revenue. This is a positive data point when they assess if your business can repay the credit that they give you. Number 4 is consistent revenue and documentation. Although there are still lenders that will give business credit on a no-doc basis, that list is getting shorter and shorter. For example, 2 years ago, a client was able to secure a $25K business credit card and line of credit at KeyBank with no documentation days after opening the account. This year, when applying for these same products, I've seen KeyBank ask for 5 months of bank statements. So to prepare you for this shift, you should maintain financial documentation and history in case a lender asks. This includes bank statements and profit and loss statements for your business as well. And if you can't do it yourself, you can easily hire a bookkeeper to create them for you. So yes, these are additional variables that lenders haven't always considered in years before, but things have changed. And if you want to get high limit approvals, you have to be ready to prove that you can handle them. Follow this banking behavior checklist and you'll dramatically increase your chances at securing the bag with business credit. And banking behavior isn't the only shift happening in the funding landscape. But this next change isn't about making it harder for you to get business credit. It's about opening your eyes on how to get an even bigger bag. So pay attention. Previously, traditional banks were the go-to source when it came to business funding. I'm talking big banks and credit card companies. Chase, Amex, Bank of America, you get the point. But here's the catch. These lenders have controlled the credit space for so long that they've forgotten about the little guy, the small businesses and entrepreneurs like you and me. They serve the biggest companies in the world and often don't have time to consider smaller business owners. This means stricter lending requirements, more documentation, and higher chances of being denied. So what do you do if you aren't a business making millions or don't have the best credit score to show these traditional lenders? Well, let me show you. Funding from traditional banks is like applying to Harvard. Even if you're smart enough, they also want you to have years of experience, come from the right family, and be almost perfect in every other area. But now there's another option. I call them fintech lenders. Short for financial technology, fintechs are like startups of the business credit space. They don't need you to have a perfect resume. They want to know that you can deliver results right now and still have the potential to grow. When you apply for funding with fintech lenders, they don't make their decision based on your credit score. They use financial technology to integrate with your business bank accounts or your accounting software. This allows them to make an approval decision based on how your business is performing and not your personal credit score. So, if you're a business owner with strong cash flow or revenue, but bad credit, you can still secure a bag in business funding. And now that you know what fintech companies are, let me give you 3 examples of lenders that'll fund your business even if you have bad or no credit at all. But before I get to these lenders, if you're getting value or enjoying this video, make sure you drop a like and subscribe to the channel below. It helps the channel reach more bag chasers like yourself and overall helps us all secure a bigger bag. So I definitely appreciate you being here and rocking with me. And once again, hit that subscribe and like button below. Let's get it. Now the first fintech lender is Revenue. I've talked about Revenue multiple times when it comes to no PG business funding. They're changing the game by focusing on entrepreneurs who are still building. Revenue uses plaid technology to integrate with your business bank account. And once connected, they give you access to a flexible spending limit purely based on your business revenue. And if you're a new business owner or have bad credit, but your business is bringing in decent revenue, this is a good option to increase your funding amounts. And you're able to get access to your funds within 24 hours. No more waiting days to get approved like with traditional lenders. Number 2 is Divvy. The Divvy card is another no PG fintech lender that uses tech to analyze your business bank account. They do require a soft credit inquiry to verify your identity, but it's not a personal guarantee. And not only does Divvy give you access to business credit, but they also provide innovative financial tools within its online dashboard. Plus, they report activity to Dun & Bradstreet, which helps build your business profile and history over time. Just another great fintech option for business owners working on their personal credit, but that have consistent business revenue. Number 3 is the Mercury.io card. One of the newest, most innovative fintech lenders in the game is Mercury. The Mercury.io card is designed for startups and new businesses. And much like other fintechs, they connect directly to your business bank account to determine your spending limit. And Mercury is known to give slightly higher credit limits, and they also offer 1.5% cash back on all spending. The great thing about fintechs is that unlike traditional lenders, they fully embrace technology. Mercury exemplifies this. They offer built-in integrations with accounting software like QuickBooks and other automations that help you manage your business finances. They also report to all the business credit bureaus to help you establish your business credit history and score. This just gives you a better chance at securing even more funding options in the future. Ultimately, these fintech lenders are drastically changing the business credit landscape, offering entrepreneurs no PG funding that comes with higher limits and less red tape is a game changer. They're not only giving business owners more options for funding, but also forcing traditional banks to innovate and reevaluate their old school approach to giving business credit. But here's the thing. Although fintech lenders aren't judging your personal credit, they are reporting your activity to the business credit bureaus. And this marks the next big shift in the business credit environment, and it can severely impact your future approval odds if you don't adapt. In years past, we can agree that your personal credit was the biggest determining factor when it came to getting approved for business credit. But now, lenders are looking even closer. They want to know how your business is managing the credit it already has. I was working with a business owner who had already secured funding for their business. But every time they went to apply for more, they got the same result: denied. Their personal credit report checked all the right boxes, score in the 700s, and a low utilization rate. So what was holding them back from securing even more business credit? Well, it wasn't until we looked at their business credit report that we found the answer. They initially built their business history using the tier method. And this entails working with vendors to obtain credit lines on a net 30, 60, and 90 payment term. And when we checked their Dun & Bradstreet report, we saw that a net 30 trade line had been reported as late. This late mark dropped their business payback score and negatively impacted their business credit profile. This was causing lenders to deny them for any new funding. And the thing is, most business owners don't even pay attention to their business credit reports. But in today's landscape, bureaus like Dun & Bradstreet, Experian Business, Equifax Business, and the SBFE are now playing a much bigger role when it comes to your business getting approved for credit. So, what does this mean for you? Well, next, let me show you how to make sure your business profile doesn't hurt your chances at future funding. And here's how. You can sign up for a Dun & Bradstreet service to easily track all the information they report and understand your Paydex score. For Experian Business, you can obtain an Experian Smart Business Report to view an analysis of what exactly they're reporting for your business. And although Equifax doesn't have a public dashboard to view your business report, you can use a service like Nav to monitor it instead. Nav is a great option to pair with Dun & Bradstreet because it allows you to view your business credit reports from multiple bureaus instead of just having to go to each one individually. Lastly, you need to make sure you address any inaccurate data on your business credit report. Similar to personal credit, you can dispute items on your business report as well. Both Dun & Bradstreet and Equifax Business allows business owners to dispute any inaccuracies found on the reports right from the website, whether it's an incorrect address, misreported late payments, or accounts that don't belong to you. Having up-to-date and accurate information on your business report is the best way to ensure you aren't getting red flagged by lenders. So to recap, these are the 3 massive shifts that are happening right now in the business credit space that you have to adapt to if you still want to secure funding for your business. 1. Lenders are considering more than your personal credit to approve you. They also want to see that your business is exhibiting clean banking behavior as well. 2. Fintech lenders are emerging as viable funding options outside of traditional banks and credit card companies. They don't judge you on your personal credit and instead lend based on how your business is actually performing. And lastly, lenders are now monitoring your business credit report alongside your personal report. So make sure you're properly managing your current business relationships if you want the opportunity to build new ones. Now, even though you understand how the business credit game is changing, it still doesn't mean anything if you overlook this crucial aspect when building your business. To have the best chance for high limit approvals, your business needs to check all the right boxes so lenders know it's legit. So make sure you watch this video next, where I show you how to properly build the foundation for your business that lenders want to see and approve. Let's get it.